My pleasure to introduce to everybody Samantha LaDuc, who is the founder of LaDucTrading.com and the CIO at LaDuc Capital. Samantha is known for timing major market inflection points in equities, commodities, bond rates, currencies, and especially volatility. As a macro to micro analyst, educator, and trader, Samantha makes her insights available to active traders and investors who want to minimize risk while seizing year-making opportunities. Samantha, welcome back to Money Show. We're happy to have you. The floor is yours.
Thank you so much. Welcome, everyone. I am excited to come here and kind of talk about dollar yields, gold, and oil, how I see the macro trends forming. In particular, we've had a historic year. The US dollar is down 11% in 2025. Oil has dropped 31%, and gold just overtook the euro as the second most held reserve asset in the world. I contend this isn't random. It's the result of deliberate policy choices. So a little bit about this presentation is that I really want to focus in on the reasons for this fall in the dollar and separately oil, strength, and gold and how it will impact equities. First, kind of overview, a quick Trump trade tax tariff agenda that did fuel a foreign capital repatriation event during that February to April fall where equities, dollar, credit, bonds, they all kind of collapsed on this outflow of repatriation. We'll talk about one of the reasons that it triggered Section 899 if it had not been pulled back from the OBBB Act, which is the most recent congressional approval here of the agenda for increased fiscal deficits and the debt ceiling raise on July 4th. If it had not been pulled back, we would have been seeing a much larger foreign investment exodus and a stock crash. So this is why it's important to talk about the dollar. I have a saying, the dollar makes the weather and its rate of change determines its velocity. So its severity of that weather. So right now the world is de-dollarizing. We're not going to harp on that too much, but the beneficiary has been gold and it is a trend. Oil can also fall while yields rise under fiscal dominance. So these are macro themes that I want to detail, and this is a client presentation that I'm making available to those attending this presentation. So thank you very much, Money Show, for the invitation. And it's timely because what happens to the dollar if Trump demotes Fed Chair Jerome Powell and or the Fed institution itself? So we'll talk a little bit about that as well. Right now, just a quick background. My name, as you know, Samantha LaDuc. I am very much focused on pulling back and looking at major macro trends early, and then I translate all of this kind of complex market data into tradable sector rotation themes. That's really where I focus an enormous amount of my effort, and then select stocks and put them in portfolios for clients. Chase, swing, trend time frames. It's all about anticipating the market direction when volatility comes to rear its ugly head and reprice equities. So I'm very much looking for inflection points that move markets and all assets, all time frames. So I'm using this background of macro, which is large part economics, fundamentals, but I'm also using technical analysis, quant, intermarket sentiment, all of this stuff to deliver the actionable trade ideas and setups. I do not work alone. I actually run a full service financial research firm. This is not just detailed analysis. Like this particular presentation is based on a report for clients, and it's a deep dive macro research. But I also have live trading rooms and options education and 10 dedicated seasoned contributors who are also posting their analysis and trades. So this is a perfect service for active traders, investors who really value custom trade support and portfolio picks across chase, swing, trend timeframes, as well as income portfolios and futures. So this is my deep dive macro research on the dollar and associated impact on yields, gold, and oil, but it's not AI driven in any way, shape, or form. It's all original thought. So I invite you to kind of keep that in mind. I have to silly disclaimer that it's not AI, but so much is driven by AI lately. I wanted you to know exactly where I stand on that. All right, so here's what I want to break down for you today. We only have 30 minutes, so we're going to get right into it. Balancing trade is dollar bearish. We're going to talk about that now. Is a policy agenda. The United States is still exceptional. We'll talk about that as well, so worry not. Capital flows, however, and confidence are driving the flow into gold and out of US dollars. So there is a trend we'll talk about. Dollar devaluation, what it means for yields. My lower oil call is still in view. I'll update that for those who do follow me closely. They know my call from last year, and that's working. trading. And then a final thought about Trump firing Powell or demoting the Fed as an institution. And then last but not least, a little bonus section that I provided clients that I'm sharing with you, the dollar trade playbook. I have a strong thesis even before Trump got elected that, and I posted a lot about the overvalued US dollar and how I expected a Trump win would be dollar bearish and how the Trump administration would put into play policies that would reduce demand of the US dollar by foreign investors on top of the de-dollarization movement that was already underway. So this was a post, a quote from March 27th to clients after the dollar had already fallen from 110 to 105. Currently higher US rates and inflation make terms of trade ugly, especially with US dollar as reserve currency. We can see that movement grow from trade settled locally between nations or in gold to China's mandate to move away from oil as largest imported commodity, and with it their dependence on the petrodollar in trade. The problem is clear. US production has become less and less competitive. The solution, according to Trump, Lutnick, and Bessent, Treasury Secretary, the loss of competitiveness from US manufacturers means the US dollar has to fall, and that they contend will save the US manufacturer. The de-dollarization movement is also one really big reason why gold is rising over the past year, and ironically, this is why China has risen the past few decades. And Jeffrey Fouvray, who is our economics advisor for our clients at LaDuc Trading, also chimed in to say, yes, this is why China would not have been able to advance so much like it did if US did not have FX as reserve. So from that March post, the US continued to fall with equities during February to April drawdown, contrary to when many expect that the dollar rises in a risk-off market. Nope, the dollar fell. And despite the rally back to all-time highs from April to July, the dollar fell. So in total, the dollar has fallen 11% peak to trough. It's now in the $97 range, and many are expecting a resumption higher in the dollar given the economically bullish Trump policies that are expected to support higher growth, and by extension, a strong US dollar. At least that's what equities are pricing in. And many can also kind of see a technical support line here that would be a really good kind of, I like this area for a bounce short term. However, the problem is that a rising dollar is bad for our twin deficits. Twin deficits meaning our trade deficit with our trading partners, as well as our fiscal deficit, just from living outside our means for so many years. And that's another reason why gold has been so well bid of late, by the way, during both the Biden and the Trump administrations. The other problem with the higher dollar thesis is that Trump and Bessent want a falling US dollar to offset these higher tariffs, in some cases much higher tariffs. So this is an effort by the administration to balance trade and incentivize domestic manufacturing and domestic savings and consumption. And just as a side note, I mean, these are the things that actually China is good at. We're not so much good at this. So he's trying to reverse this trend. So in a nutshell, even though the dollar might be bouncing at that 97 in the near term, that's potential, breaking 100, let alone 90, let alone 80 is not priced in. So that's why I said, again, my mantra over the years has been US dollar makes the weather, but its rate of change determines its severity. So let's fast forward a little bit and go back to, okay, well, wait a minute. This is worrisome, but let's still focus on the fact that the US dollar is still exceptional, and we were saved from an event that would have crashed the dollar. That was in February to April. We came very close. Now, let's go back and kind of talk about why I still contend that this dollar falling 11% in the first half of 2025 was a feature, not a bug. The Trump administration policies are very clear. They're levying high tariffs, not to mention the policy uncertainty for foreign investors. That triggered my mantra of money goes home. So they kind of left. It was too much risk. And FX currency exchange was hitting, and they hadn't been hedged in the past. So hedging activity kicked in. They were, after decades of not hedging their US investments, they started to hedge. Also, Trump pulling back from NATO. That forced Germany and the EU to kind of create this defense QE, which is they have to fund their own protection. That caused foreign yields to rise in other countries relative to US, driving the yield chasing abroad, and also money staying home activity. That's another reason. De-dollarization trends were already in place. It's a slow kind of boat. but it is definitely picking up. So more trade is occurring outside of the US dollar in favor of gold. That's a part and parcel of why the dollar has also fallen. But a big reason why it stopped falling was Section 899, I believe. So US fiscal concerns caused these foreign investors to disinvest from US markets. And honestly, this is something that I think was a little bit under the radar. But Section 899 is a repatriation trigger, and it was a proposed tax that was floated by Trump and Bissent just before the passing of the big act, the OBBB. It was removed. So it was trading leverage. It is very much a major tax on foreign holders of U.S. investments. Now, some would argue, now they have a pass. Some would argue it is more in line with capital controls because it would tax foreign investment in the U.S., where there were no taxes on foreigners before who hold U.S. assets. And it's a big area of holding. So total foreign holdings equal 20%. This is a huge amount of the equity market. Some even estimate higher, but Apollo's on the conservative side, so I went theirs. That's 14 trillion US dollars worth of foreign holdings in US equity markets. It's 30% of our corporate credit markets. That's about $4 trillion US dollars. And it is 30% roughly of our treasury markets, which is 12 trillion US dollars. So that really matters. The capital risks of repatriation from this Section 899 was a repatriation trigger, and it helped front run the money goes home during that period of time. I had written about this in February because this was already an idea that had been floated, an executive order on February 21st. Point is, the US was readying a tax on foreign capital, not just goods. So this is dubbed the revenge tax. It would definitely, some argue, is needed for revenues or just to foreign national taxation. They've been getting away with it too long. But the point was, it was a capital war. And it further supported my whole thesis of money goes home, money stays home for safety, for yields, for less FX risk. And that contributed very much to the capital outflow that we experienced the first half of the year and has not recovered. So this is basically the same incentive as a tariff. You force local consumption and production, you force a falling demand of US dollar, you force political control, as these taxes are just easier, and I'm talking about the Section 899 taxes, are easier to levy. And the approach, however, means really there's a lot of repatriation if this is to come up again. It was pulled back. The markets very, very firmly bounced. Not just the Trump policy intervention of April 9th, where he said, okay, we know you're upset, bond market, equity market, credit market. We're going to delay these tariffs. It gave the market an absolute V-shaped recovery and time to digest impact, potential impact, and all the other promises by the Trump administration. But the fact is, if this comes back into play, keep this in mind. We have a very large deficit with lots of repatriation that risks more convulsion should that come to pass. Right now, we're out of the woods. They pulled it back, threats done, but keep it in mind. So in the meantime, this has all challenged the US as a safe haven. So this particular chart, courtesy of DataTrek, is from July 20th. So it's very, very current. This is developed currencies and how they have rallied massively year to date. This is historic, by the way. Our first half is a historic dollar dump, for lack of a better word, and outperformance by emerging markets, not just their currencies, but also in their equity markets. Exceptionalism is still in the US dollar, but more money is now looking to seek higher yields and returns abroad. That's a trend that will continue. Anyway, the falling US dollar relative to peers, it should not be a surprise. Trump administration levied high tariffs, threatened and then levied, and US trading partners were freaked out. So this is going to be a theme. It's not done. Trump wants to reverse large trade deficits that we have. And it's not a surprise that we have large trade deficits. We should. We run a current account deficit so that foreign hands want to hold our paper. We are also a trading partner with currently no capital controls, like the Section 899. We also have FX convertibility that is tied to deep liquid pool of collateral and assets, like our treasury market. It's also very easy to use. It's a very easy to use settlement system, and it's extremely large. And it's stronger because because we have above average economic growth. So these are all good reasons why the US dollar is the reserve currency, world currency. But as a result of that, and because there isn't an alternative to the dollar, it should also not be surprising that the US equity exceptionalism has resulted in a $96 trillion NIP. And IIP is basically you take our US investments overseas minus the foreign investments in the US, and you get this balance. And we consume based on debt. We're not trading in like goods and services, or it's not a barter system. We're not trading in gold. We actually are in debt trading, and this is the result of a very large deficit. So why does this matter? Again, Jeffrey, our economics advisor, who I have worked with very closely because he is an expert on emerging markets and fiscal dominance, sums it up pretty well. He said initially, it's free money. In other words, the government debt that the US has accumulated from trade and fiscal deficits, it's not a problem. There's no yield spike issue. It's easy to maintain suppressed volatility, rate suppression, all that good stuff. Eventually, when the debt is really large and the primary deficit, that's a key word, primary phrase of deficit is really large, like now, it starts to hurt consumption. And we can no longer, this is the key, spend more than we produce. So this is, in a nutshell, where we're at. If they devalue the dollar and rebalance the spending, at the same time, we do all these domestic output enhancing infrastructure projects. Right now, you know, there's lots of pull for companies to invest in the US, whether it's Toyota or invest in AI data centers. The point is, Trump is trying to attract output enhancing infrastructure projects, and then you add tariffs on top of that, you increase government tax receipts. So more is produced domestically, and ultimately, hopefully, lower inflation results because we have the same or slightly less government spending, but it results in more output. Anyway, long story short, we reverse. Instead of spend more than we produce, the end game is a world where we produce more than we spend. So think of it that way. I think it might be easier. But that's the end game. In the meantime, we have a dollar that is very disconnected. Sorry, I'm on the wrong slide. Is very disconnected from US rates. And this is a new phenomenon since the April tariffs were announced. Okay, since all of this threatening of Section 899 and tariffs and the chaotic or confusing trade strategy. So capital flows have started to move into gold. We'll talk about that. But first, the major advantage of foreigners holding the world reserve currency and investing in US dollar denominated assets was immediately at risk as soon as Trump was elected. So if the 899 had been passed, it would have penalized them for holding dollars, which was a big leveraging tool in the trade negotiations. The result has been a steady bid in gold, not just in 2025, 2024 as well, because the risk to holding dollars had increased from exploding higher US fiscal deficits, more spending, from a transition to fiscal dominance from monetary dominance, in the same way that Trump is trying to have control over the Fed instead of an independent entity. Anyway, not to mention the falling value of US treasuries. Have you seen the returns on bonds since August of 2020? They're abysmal. There's been no stock bond risk parity in play. And of course, because, another reason, the dollar fell from these kind of chaotic or uncertain trade policies. So prior to this disruptive period, and you can see this on the chart, we were fine. But we can see now the value of the dollar has driven by these rate differentials with foreign investors drawn to the US because of our superior economic growth, our deep moat of advanced technologies, and of course, this deep flowing liquidity in equity, credit, and bond markets. It's critical to maintain that exceptionalism. But all that changed with Trump's trade wars in April. So we're in that bumpy period. The result is more likely higher US yields and higher term premium with falling US dollar, which lends itself to a continued bear steepener for those in fixed income. That's the 10 and 2-year yield curve, all of which present a headwind in time to equities in the future as recession risk is pulled forward from reduced bank lending. They're already starting on the consumer, not business. Compression of corporate margins. Believe it or not, they are flat year to year. In addition to rising inflation, which is still a worry, and jobless claims, which is not. But all of that can erode consumer health, for sure. And it's starting, kind of like a 2006, 2007 vibes. Unless Trump follows an ancient playbook, inflate our way out of debt, which, by the way, worked for Greece recently, where they had decent tax collection combined with inflation, and that reduced their debt levels substantially. And that supported their bond markets and pushed yields lower. So that's what he's going for, my humble opinion. Whether he pulls it off, that's another matter. But the direction and the path of holding US dollars as a percentage share of foreign exchange reserves is falling. So the trend is still in play as it relates to the falling demand. Sorry about that. This one right here. As it relates to the falling demand for US dollar. And that has absolutely resulted in more gold being demanded by foreign investors. So we have this trend. It's a path of holding US dollars assets as a percentage share of foreign exchange reserves is clearly falling. And this is what has now happened. You got gold overtaking the euro as a second most held foreign reserve asset. Impressive. All right, so this has really been happening over the past few years. It's been escalating, basically. So it fell 10%, the dollar denominated, and then it has, in the past decade, gold has risen to the number 2 position and euro has fallen to 16%. This is post-financial crisis. So in 2011, central banks started rebuilding their gold holdings after having spent decades unloading them. And then 2022, 23, 24, they suddenly bought gold hand over fist at a record pace, over 1,000 tons of gold per year. It doubled the average of the prior 10 years, and the price of gold spiked from this buying pressure by central banks. These purchases of over 1,000 tons of gold per year for 3 years in a row pushed up total gold holdings by central banks to 36,000 tons, close to the all-time high of 38,000 tons in 1965 during the Bretton Woods era. Long story short, macro headwind and trajectory of the US dollar creates this trend in gold, and it does not look done. So what does this mean for yields? The US dollar role, as I have said, gives it immense negotiating power and geopolitical power. US can use financial sanctions in lieu of military intervention, but its other benefit is that it creates lower cost of borrowing, the true exorbitant privilege. That has translated into more investment into the US, more growth, higher incomes on the aggregate in the US versus rest of world for several decades. Now the trade-off, of course, is economic cost of hollowing out our industrial base, resulting in our dependency on adversarial supply chains. But it also has triggered this unproductive use of money in the financialization and speculation in our US equity and crypto markets. So it does have a dark side. Our equity market, therefore, kind of by extension, is exceptional because of the US dollar and the foreign capital that is attracted to our equity, credit, and treasury markets. Again, think about that Apollo chart that I showed you. Massive foreign holding in our equity, our credit, and our treasury markets. So by supplying the world with dollars through all of our trade consumption, fiscal spending, the US created a structure of consumption over production and debt over independence, and this has entrenched the dollar's dominance. Now the Trump admin wants to try and change all that. They want to use tariffs and trade deals to balance our budget. They want to drive tax receipts to offset government spending. And the consequences of these policies, I contend, is a devalued dollar. De-Dollarization by BRICS is also in play. So you've got speculation for sure of the pace at which it's going to take place. That's not my game. I just look very clearly. China has been decoupling from the US since COVID, also developing their own international settlement system. They transact with trading partners outside of the USD. This trend is definitely going to accelerate over the next decade. And that further, Trump% believe a weaker dollar makes American companies more competitive. So it's going to reverse this trend of outsourcing. It's going to be bumpy, but that is the goal. So we're not so dependent on other political adversaries for supply chains for critical semiconductors and antibiotics and critical minerals, etc. So a weaker dollar, in a nutshell, is going to supposedly trigger or incentivize U.S. onshoring as a way to help America be more resilient again. So what does it mean for yields? Well, you can see the trade war is a little bit of a stagflationary shock according to lots of, let's say, academic modeling. This is Yale budget, you've got CBO, etc. This is really about rates getting cut, triggering inflation. And Trump is really pushing the market's buttons to believe that we can have our cake and eat it too. Time will tell. But changing the terms of international trade, this is important, is this Mar-A-Lago Accord. It is to pull down the dollar to give us leverage for this golden age. Affirm the US dollar global standing, prevent dollar flight, restrain long-term interest rates and inflation. It goes on. They want it to result in offsets to government borrowing from the tariff revenue, from higher wages, from lower interest expense. wants to cause a falling, smaller trade deficit, a slowly depreciating currency, all the while maintaining steady employment, 3% growth, and no spike in borrowing costs. That's the Mar-a-Lago Accord. That's the Trump put. That's the promise to equity and bondholders for both an industrial renaissance and economic growth explosion. Many are pricing this in. They're not just pricing in rate cuts, they're pricing out growth shocks. They're pricing out yield spikes as if inflation will stay muted with prices, so corporate profits and consumer spending trend higher. That's not my bet, but I hope it works out. And in a nutshell, lower oil is part of it. I posted my views in, early 2024 that crude would fall into the $60 to $40 range by the end of 2025. And it continues. I followed up in the fall talking about how oil price can fall as yields rise. We already tagged 55 handle in WTIC. We've had a 31% drawdown peak to trough, all while the dollar plunged 11% in the same period and yields stayed bid. More on that, but I'm going to run out of time. I have this presentation available for clients, but I definitely want to keep it open conversation. Anyone who wants to follow up with me that way, you definitely can. Final thought, Trump firing Powell or demoting Fed is an immediate dollar buster. Ken Rogoff, former chief economist at IMF, emphasizing the Fed will lose anti-inflation credibility and the general level of interest rates will rise, not fall. And then that kind of brings us to the dollar trade playbook. Last but not least, short US dollar until signs of fiscal dominance reverses and US transitions to a system where we produce more than we spend. That's going to take a little while. Long gold, silver, select commodities, not oil, until US trade is balanced and or fiscal restructuring. What are the chances? Short, longer duration bonds until the 10 and 2-year yield curve gets to about 90 to 100 basis points positive. Long equities during slow FX debasement with focus on real assets, my things over paper theme since summer 2020. Short equities during fast debasement as foreign capital flight ensues. This is where you can find me, LaDucTrading.com. This is a special for those interested. Again, I've got a whole team of 10 subject matter experts from macro to micro, and I invite you to engage with us live. Thank you so much.
Samantha, thank you very much. Great presentation. We had a great crowd. We appreciate you at Money Show for doing this, and we want to wish you a very good rest of your day and rest of your week. And folks, thanks for joining the session. Samantha, thank you again from all of us at Money Show.
Cheers.
Take care now. Bye now.
Subscribe to LaDuc Trading YouTube channel for more videos.